There is a price for metals. Look at the cash markets. Look at the Shanghai market. Look at the cash exchanges versus New York or London. Those two are paper exchanges. And you have a bifurcation between the paper market and the cash market. The answer to your question is when silver fails to deliver, gold will be right behind it. And we're talking about derivatives now. That is well over a $2 quadrillion market when all the assets on the planet of Earth are what, 300, 400 trillion. Yeah, you're asking me about the markets today, gold and silver, uh, and they are markets plural. When I say plural, I'm talking about the paper market and the physical market. The paper markets are becoming irrelevant, if you will. I mean, you've got $75 silver in New York, in London, yet you've got $80+ silver in Shanghai, uh, higher in Japan, higher in UAE, Dubai, all over the world. The physical market is trading above the cash market. I'm sorry, above the futures market, the paper markets. When a spot price trades above the futures price, it's called backwardation. That should never happen because how could an ounce of gold be valued today less in the future than it is today? It can't be because there has to be some time value of money. So that's a very rare occurrence. But what you're having happen now is you've got backwardation between markets themselves. The cash markets are trading above the futures markets, the paper markets, and that's people, investors, buyers. Uh, this is not about stackers. Silver, the big demand is coming from industrial use. But the point I'm trying to make is you have the paper markets and the physical markets separating. If you want to call that backwardation, you can call it backwardation. But what it tells me is that the paper markets in short order are going to become irrelevant. It doesn't, everybody's worried about price. Forget about price. The bottom line is, do you own it or do you not? How many ounces do you have? You're going to count your net worth in the future in ounces, not dollars, not yen, not euros. You're going to count your net worth in ounces. So price does not matter because silver is going to go through a failure to deliver. And when that happens, you either own silver and have it or you don't. You're either in or you're out. And if you're out, you'll never be able to get back in. You'll never be able to get in. There won't be physical metal for you to buy with fiat. Fiat is not going to be accepted for physical metal. So don't worry about price. Just get capital out of the system into metal. Metal can't bankrupt. The system is bankrupting. Yeah, I mean there are some very good mining companies out there that you want to be a part owner of, but you want to make sure that when the system goes down, that doesn't get taken out from under you. When you buy a stock in today's world, what happens is that that stock is owned. It's on the books of your broker for your benefit. Now, if the broker gets into trouble and they become insolvent, your shares are on their books. Your shares will go to pay their creditors, and you're out of luck. Same thing with banks. When you put money into a bank, you're no longer legally a depositor. You are a lender, and you're the most subordinate lender there is. So you're only going to you won't get anything, but when the system comes down, it goes tranches. The most senior, the next senior, and then the subordinate is on the very bottom. If there's any crumbs left, you get to fight over those. But there won't be crumbs left. And ask yourself this with a broker. How can these brokers do trades at $7.95, $7.95, no matter what size? The answer is, and I mean, look at the money that these brokers spend on private jets, limos, big buildings, blah, blah, blah. The overhead is stupid. The way they pay for that is you buy a stock today, you put the money in, by the end of the day, your stock is already lent out. They earn the margin interest on lending your stock out. So the way to protect yourself, get your certificate.
In stressed markets, price becomes secondary to access. The real question is no longer, what is silver worth, but do you actually own it? Financial history shows that during systemic breaks, contracts fail while tangible assets endure. Precious metals are not purchased for short-term gains, but for continuity of wealth. As delivery pressure mounts, shortages emerge quickly, locking latecomers out. When settlement shifts from metal to cash, confidence evaporates. At that point, currencies lose relevance, and value is measured by ounces, not symbols. Wealth preservation becomes physical, not digital.
That's the way it used to be until 2014. From 2014 on, the West has been changing the laws, and they're all on the books now. The ink is dry. The West is set up for the great taking. Well, first off, it'll only take you an hour to either read it or watch David Rogers Webb do a 1 hour interview talking about it. And basically, I just outlined it. The bottom line is when the system comes down, your assets are going to be used to try to support banks, brokers, insurance companies, financial institutions. Your money is no longer yours. Your money is being held by intermediaries. It's on their books, and when the intermediary fails, you're going to lose your assets. But spend the hour to read or watch The Great Taking. Well, I would ask you to go back and remember what happened in April of 2023 when those 3 banks in California went down on a Thursday or Friday. I was on a short trip. Turned out really not to be a trip because the phone started blowing up. People were scrambling to buy metal, and by Monday morning, no dealers had any metal left in stock. And I mean, we were taking orders with the promise to deliver in 6 weeks. So what I'm getting at is this can happen very quickly, and I'm on the record that this will end up as a failure to deliver, and I believe that will begin, or that will happen first in silver. It'll be followed by gold, probably within 24 hours. You mentioned squeeze. Squeeze that looks toward price. So have we been in a squeeze? Yeah, absolutely. The price is going higher. But the danger is that there's more delivery demands than there are ounces in inventory to deliver. And that failure to deliver, COMEX will issue force majeure. They'll pay people in cash. That way they can say, no, we didn't default. But make no mistake, it is a default. If you bought a silver contract with the expectation that you could stand for delivery, get the metal, and you don't get the metal, that's a default. They're from a technical standpoint, they can legally say it's not a default, but in the real world, that's a default if you don't get your metal. Yeah, I think at 55-56 ratio, I think we're in no man's land. When we were in the 70s, 80s, up to 120, I mean, that was a no-brainer. You buy silver, and at a later date, you sell some silver and swap back the gold, and you'll get more ounces than what you would have had you bought the gold outright to begin with. So as the ratio comes down, I've said that I think people need to move in tranches. If you're looking to move X amount of dollars or X amount of percentage of your portfolio, I would do a quarter at 50, a quarter at 40, a quarter at 30 to 1, and then the last quarter you do as a just a gut feel trade. You're not going to be able to pick the bottom, but if you do it in tranches, you can't be wrong and you can't be right, but you'll be better. You'll end up with more gold ounces than you would have if you didn't do that.
Most investors believe their assets are secure, yet few understand how modern custody works. Stocks, bonds, and even cash are held by intermediaries. In a failure, those assets become part of the institution's balance sheet, exposed to creditors. Recent bank collapses revealed how fast access can vanish. Bail-ins, not bailouts, now dominate policy. This means depositor funds are legally available to stabilize failing entities. Precious metals held directly carry no counterparty risk. They cannot default, be rehypothecated, or frozen by institutional failure. That distinction may soon define survival.
Yeah, as long as and the ratios come down, but still at 55, 56 to 1, I've said that people should be at least 70-30 in favor of silver with an eye toward swapping silver at a later date for gold. And I told people for the last 5+ years that if you want to be 100% silver, I don't have a problem with that. Um, but when all is said and done, you want to have more gold than silver. I mean, optimally, you want 60, 70% plus in gold versus silver during normal times, but we've not had normal times or a normal gold to silver ratio, probably for 30 years. So silver has been the target. Silver is where I believe the failure to deliver will happen. And the bottom line is once it fails to deliver, you're either in or you're out. You're not going to be able to alter your position. You won't be able to buy gold. You won't be able to buy silver. If you don't have it, you're locked out. Well, it certainly heats up geopolitics. Uh, and if you go back to what was it, October of 2022, I believe, was when Biden sequestered, confiscated, whatever you want to call it, 300 billion of Russian Treasury reserves, U.S. Treasury reserves that they were holding. That was outright theft. And from that day forward, gold started moving higher because nation after nation looked at that and they said, if they could do this to Russia, they can certainly do it to us. So that was the beginning of this move of de-dollarization, if you will. Uh, Going in and basically just taking over Venezuela, it's not a good look. I understand what they're doing, and it will. They're trying to get what they're trying to do is they're trying to get assets that are not encumbered that they can use as collateral, and obviously the oil and the gold and the silver, whatever uh, other commodities that they can take from Venezuela. But it's not a good look, and it certainly accelerates. If we're going to go to war, it certainly accelerates that happening. Yeah, it can be an addition, but understand it's basically an industrial metal, and if you get to the point where uh, the real economy is upside down and basically, I don't want to say closed, but severely hampered, the demand for platinum is going to drop. Platinum nor palladium are considered precious metals. They're not considered money. Gold and silver are money. The reason you want gold and silver is because they are monies that cannot default, and the system is not tenable, and we will go through an insolvency default. The system itself is in the process of defaulting. So you want your capital outside of that system and in something that cannot default, and that something should be money, gold and silver.
Silver sits at the intersection of industry and money. Unlike gold, it is consumed. Inventories are thin, demand is rising, and years of structural deficits have left little margin for error. A delivery failure doesn't require a price spike. It requires insufficient metal. Once contracts cannot be fulfilled, exchanges may settle in cash to maintain legal standing. But economically, that is a default. Gold would likely follow shortly after. The danger isn't volatility, it's finality. Once confidence breaks, markets don't reset smoothly. They shut, reprice, and exclude.
Let me go at it from this angle. In a system breakdown, where you've got financial markets either uh, having a problem opening, functioning, or not even open, with a societal breakdown, and that's where this is going to head to. With a societal breakdown, what good is a 100-ounce bar? I mean, what are you going to trade it for? How do you trade it? You can't. Um, The problem I see with bars of any size, 1 ounce, 10 ounce, 100 ounce, the problem I see with generic rounds is that how are you going to prove it's real silver? In a system breakdown, how do you authenticate that? In a The way to authenticate it is junk silver. Everybody knows what a dime, quarter, or half dollar looks like. As long as the date is 1964 or earlier, that authenticates that it has 90% silver. You could drop a dime or a quarter on the counter and it's going to sound way different than a current dime or quarter. That authenticates it. It's U.S. Mint lineage, meaning it was created by the U.S. Mint. They have to be scruffy, so they cannot be counterfeited. When I say they have to be scruffy, these were in people's pockets for, 10, 20, 30, 50 years. So they've got to be scratched. They've got to be dirty. If you see a clean dime or a clean quarter or half dollar, it very well could be a counterfeit. So it can't be counterfeited. It's readily recognizable, and it's the smallest unit. 14 dimes equals 1 ounce. So that gives you 14 transactions versus one with a 1 ounce bar, an eagle, a maple, a generic round, a 100 ounce bar, whatever. If you're trading with a farmer for eggs, you give them a dime for a dozen eggs. But if you don't have any dimes, you only got 1 ounce pieces. You get your dozen eggs or 2 dozen eggs. Now you're issuing credit to the farmer. He owes you eggs. And I would just say, like Ben Franklin, neither a lender nor borrower be. So, I mean, junk it's the best form for an American to own, and it happens to be the cheapest form currently. I mean, it's cheaper than any bars, any rounds. It is the cheapest form. And the reason it's cheap right now is because of the run up in price. You had people that bought back in the 70s and 80s, and junk was really the only way for Americans to buy silver. A lot of that's coming out of the woodwork. People saying, oh, I finally got my money back, or I finally made a profit. Lots and lots of junk silver this past year was sold. Dealers backed away from it. I mean, if they're bidding $5 or $6 under spot, they're sending it to a refiner and they're pocketing that $5 or $6. But it creates an opportunity for you because you can buy the best form of silver cheaper than any other form of silver. You get the best for the least.
Recent global actions have accelerated distrust in the financial order. The seizure of sovereign reserves sent a message. Assets held within the system are conditional. In response, nations increased gold accumulation and reduced dollar exposure. Resource-rich regions now matter more than financial centers. Control over energy, metals, and commodities is replacing trust in paper claims. This shift isn't ideological, it's defensive. Gold and silver are being remonetized quietly, not by declaration, but by action. History shows that when power replaces neutrality, hard assets regain dominance.
Who knows? I mean, I don't have the answer to that. Nobody has the answer to that. It could be by the time you post this interview. Who knows? All I know is we're in a structural deficit. It looks like there's going to be a failure to deliver on paper markets. And when that happens, it's game over. If anybody gives you time and or price, they're full of shit because nobody knows. And just understand that when this thing melts, when the whole system melts down, all the leverage is going to break. I mean, stock markets, bond markets, real estate markets, they're all held up with leverage. But guess what? That same leverage was used to suppress the price of gold and silver. So the way to close the gold and silver positions for these institutions, they got to buy. There is a price for metals. Look at the cash markets. Look at the Shanghai market. Look at the cash exchanges versus New York or London. Those two are paper exchanges. And you have a bifurcation between the paper market and the cash market. The answer to your question is when silver fails to deliver, gold will be right behind it. And we're talking about derivatives now. That is over, well over a $2 quadrillion market when all the assets on the planet of Earth are what, 300, 400 trillion. So there's way more bets than there are assets. That will collapse everything. It will collapse trust. It will, which thus collapses confidence. Everything runs on confidence. And guess what? The money you have in your bank, the money you have in your wallet, it's confidence money. It's been a con game. Those are the other monies. Real estate has the value that real estate has because of debt. People don't go out and buy a house with cash. It's borrowed. If there's no ability to borrow, what happens to the price of real estate? It collapses. What you're going to see is the greatest deflation in all of history of paper markets, even real estate. Across the board, it's going to be a massive deflation versus gold and silver because gold and silver are money. Real inflation or deflation versus nominal inflation or deflation. Nominal inflation or deflation would be in dollar terms or euro terms or yen terms. So it's possible that the stock market doesn't even move. And actually, you're watching it happen. You've seen gold and silver explode over the last, silver in particular over the last year, but gold and silver from the year 2000, the best performing assets have been gold and silver. The world has been in a deflation price wise versus gold and silver since the bottom in 2000.
All modern markets rely on leverage and belief. When belief fades, leverage collapses. Stocks, bonds, and real estate deflate in real terms, even if nominal prices appear stable. Gold and silver move opposite because they are not promises. They are payment. In a full systemic unwind, wealth migrates from claims to possession. Smaller, recognizable silver units historically function best in trade, especially during disruption. This isn't about prediction, it's about preparation. Financial resets don't announce themselves. They arrive suddenly, and only unencumbered assets remain on the other side.